What if I told you that the financial system controlling your life today is your bank account, your credit card, your mortgage? Even global trade itself was not invented in New York, London, or Amsterdam. What if the real architects of modern finance lived more than 1,000 years ago, trading across deserts and oceans from cities like Baghdad, Cairo, and Cordoba? They used checks before paper money existed in Europe. They operated banks without buildings. They created credit without interest and global trade networks without modern technology. And the most uncomfortable truth of all is this: the modern world did not invent finance. It inherited it and then rewrote the story. This is not just forgotten history. This is the missing origin story of the global economy. And once you see it, you will never look at money the same way again. Welcome to Finance Meets History, the channel where we uncover how money, power, and forgotten systems quietly shaped the modern world. Because history doesn't repeat randomly. It repeats through financial systems. Before the 7th century, long-distance trade was fragile, slow, and dangerous. Money meant metal. Trade meant risk. Distance meant uncertainty. If a merchant wanted to trade across borders, he carried gold by hand, hired guards, and hoped he survived the journey. There were no international banks, no standardized contracts, and no trusted intermediaries. Long-distance commerce was a gamble, not a system. Then, something unprecedented happened. Within a single century, the Islamic world expanded across the Middle East, North Africa, Central Asia, and Southern Europe. But its true power was not military, it was commercial. Islamic civilization sat at the crossroads of Roman law, Persian administration, Indian mathematics, and Chinese manufacturing. Instead of destroying older systems, it absorbed them, refined them, and connected them. At the center of this new civilization stood Baghdad. Founded in 762 AD, Baghdad was not just a political capital. It was a financial nerve center, a trade clearinghouse, a banking network, and a knowledge hub. At its peak, it was wealthier, larger, and more sophisticated than any city in Europe. And it operated on a revolutionary idea that changed everything. Wealth is created by circulation, not hoarding. Islamic law discouraged hoarding gold. Money was meant to move, and once money must move, systems must exist to support it. Trust, contracts, enforcement, and record-keeping became necessities, not luxuries. Centuries before Europe used paper money, Islamic merchants used a financial instrument called a sack. This is where the modern word check comes from. A merchant could deposit money with an agent in Baghdad, receive a written sack, and redeem it in Cairo, Damascus, or Cordoba. No gold traveled. No guards were needed. The risk of theft disappeared. Value moved faster than people. This was not rare or experimental. It was routine commerce. European traders who encountered this system were stunned. They had never seen paper replace metal or trust replace force. Centuries later, Europe would adopt this system almost unchanged and call it modern banking. Islamic banks did not resemble the stone buildings we imagine today. They existed as networks of trust. Financial activity flowed through merchant families, agents, written contracts, and reputational enforcement. Breaking a contract did not just cost you money. It destroyed your standing in society. Trust became the enforcement mechanism, stronger than police or prisons. This dramatically lowered transaction costs and allowed trade to scale across continents. Without technology, Islamic finance achieved what modern systems still struggle to perfect: speed, reliability, and reach. The contracts developed during this period still exist today, only under different names. Mudaraba functioned like venture capital, where investors shared profits with entrepreneurs. Musharaka resembled joint ventures. Murabaha enabled cost-plus financing. Ajara formed the basis of leasing. The key principle was that risk was shared, not dumped onto borrowers. Capital and labor became partners. This encouraged innovation, entrepreneurship, and long-term thinking. Debt did not dominate the system. Money fueled productivity rather than extraction. That is why Islamic cities flourished, not only economically, but intellectually. The markets themselves were highly advanced. Islamic cities operated regulated commodity markets known as souks. These were not chaotic bazaars. They had standardized weights and measures, transparent pricing, quality controls, and legal oversight. Officials called muhtasibs, enforced fairness, prevented fraud, and stopped manipulation. Even more remarkably, merchants used forward contracts. Prices for goods could be agreed upon months before delivery. This reduced uncertainty, stabilized markets, and encouraged investment. These were early futures markets, operating centuries before modern stock exchanges. None of this would have worked without accounting. Islamic merchants kept detailed ledgers, profit and loss statements, inventory records, and transaction histories. These systems moved into Europe through Islamic Spain, Sicily, and Mediterranean trade routes. By the time Venice and Florence rose as financial powers, they were standing on foundations built elsewhere. The Abbasid state understood something modern governments still struggle to accept. Finance must serve society. Taxation funded roads, hospitals, education, and libraries. Economic growth was not accidental. It was planned. But no system is immune to decay. The decline of this financial civilization was slow and structural. Political fragmentation weakened standardization and trust. Competing states replaced unity. Then came catastrophe. In 1258, the Mongol sack of Baghdad destroyed libraries, records, and financial institutions. Institutional memory vanished. Innovation slowed as systems became rigid and defensive. Europe, meanwhile, was still learning. European merchants absorbed Islamic financial knowledge through trade, translation, and contact. Venice, Genoa, and later Amsterdam adopted letters of credit, accounting systems, and commercial law. But they made one critical change. They removed ethics from finance. Interest replaced partnership. Debt replaced risk-sharing. Profit became the primary goal. This unlocked rapid capital accumulation, funded wars, and enabled colonial expansion. It also introduced fragility, inequality, and boom-bust cycles. Modern banking was born, powerful, scalable, and unstable. Every major financial crisis since echoes the same flaw. Lenders disconnected from risk, speculation replacing productivity. Money serving itself rather than society. Ironically, after each collapse, the same ideas return: risk-sharing, ethical finance, stability. And then they fade again when the next boom begins. This history was inconvenient, challenged the myth that modern finance emerged naturally from the West, so it disappeared from textbooks. But its fingerprints remain everywhere, embedded in contracts, markets, and institutions we still use today. Every financial system carries a philosophy. The Islamic world believed money should serve society. The modern world often believes society should serve money. Empires do not fall because they lose wealth. They fall because they forget why money exists. History always asks the same final question: have we learned, or are we simply repeating the cycle? If you want to understand how money and power truly shape the world, this is Finance Meets History. Make sure to subscribe because this story is far from over.